most investors, we want our cake and eat it too, right? We want zero drawdown, and we want as much growth as the equities are doing when they're doing well. Well, guess what? That relationship doesn't really exist. What you have to do, as you had just mentioned, is first identify what your tolerance is to the downside. That's what leads more often than not to capitulation in a portfolio, which is a whole nother topic that we need to get into at some point, because it can kill your ability to achieve these average returns over time of what these models or portfolio strategies are built to do. Capitulation is kind of the kiss of death. That's, I drew down more than what I expected. And we just shared the stats, right? Too many people don't understand what that worst case scenario looks like based off that business news review. And when they supersede that drawdown of tolerance, they're going to capitulate, and that creates longer term problems. So identify that risk of what you can tolerate. And then say, on the other side of that, we want to grow that as much as we can based off of the root parameter that risk matters. And if you can really spend some time with the numbers, you're really building into something that we call a very positive spread profile. And when I say spread, everybody immediately starts thinking about bonds, but I want us to think about it a little bit different. Spread for us, in the way that we think about portfolio construction, is how much can I participate in the markets when they're going up? How much do I participate when the markets are going down? So we define these as what we call up captures and down captures. And all I'm trying to do is create a baseline of expectation that when markets are moving one direction or the other, how much of that should I participate in? But here's the beauty in portfolio development. If you can keep that spread wide, this is where great wealth accumulation can occur. And to your point, Dean, I could go be in a wildly aggressive all stock model that captures 180% of the up market, but it also captures 150% of the down market. And that's still a very positive spread profile that can lead to tremendous wealth accumulation. Here's the problem, though. If you are not an investor that can stomach 150% drawdown, so let's put this in perspective, right? Let's just assume the S&P 500 was our baseline. If I was capturing 150% of that drawdown and the S&P 500's down 25%, what am I down?
37.5.
More than what the index is doing, right?
Yeah.
So if you can tolerate that, again, I continue to argue that you've got a great spread profile, but you've got to have, one, the guts to hang on, and two, the ability to allow time to play out to be the net benefactor on the other side. And most investors that we come across just don't have a tolerance level that would allow them to find drawdowns within their portfolios greater than an all equity benchmark. So we have to be very real with ourselves to understand how much can we really draw down, create that spread profile, because I can be just as powerful with a portfolio that is capturing 80% of the up and 50% of the down. It's that spread relationship that creates the real wealth accumulation over time.
Don't forget to like, share, and subscribe if you haven't already done so. And feel free to give us some comments below. If you want to watch this entire episode, you can find the link here on the screen or in the description below. Thanks for watching.
Starting your route to retirement.